Your whole world is at risk of being turned upside down. In this video, I'm going to discuss why. Your retirement account, your 401k, your everyday movements are being affected by decisions from people you've probably never even heard of before. In this video, we're going to look at what's going on with the central banks. I want to talk about the corporations and, of course, what this means for you. My name is David Quinteri, and I have been bringing out this information for well over a decade, longer than most of the others out there, and actually making this simple and easy for everybody to understand. That's the whole point of this. I spend the hours so you don't have to. Let's begin by taking a look at this. Risk of global recession in 2023 rises amid simultaneous rate hikes. So we look at this all around the world. The same situation is very evident. They're raising interest rates, tightening credit conditions. This makes it harder to borrow. Economic growth slows down. Many of the governments out there are starting to suggest that inflation is coming down. You and I have talked about this before. I don't know where that information comes from. Whenever I go to the store, whenever I have to pay for a different service, oh yeah, it's gone up. Oh, but the last time I was here it was $100. Oh yeah, now it's $150. It's the same situation everywhere. Inflation is never going to account for that. And by the way, when we go to buy a product at the store, it's always shrinkflation. Or in services, they kind of shrinkflate it. Have you noticed this? Oh, it used to include 1, 2, and 3 things. Oh, no. Now it's only 1 and 2. Oh, wait a second. So actually the price is inflated even further when you do it in a one-to-one, apples-to-apples comparison. Wouldn't you agree with that? It happens all the time, but that's never going to make it to the calculation. So who cares about the number? Doesn't matter if it's 4% inflation or 30% inflation. What matters at the end of the day is you. So now we have this risk of a global recession, and we measure it in different ways already, as I did in the previous video. The GDI, gross domestic income, instead of gross domestic product, shows us the United States is in a recession. But it doesn't matter. When we look at that, it's just a stat. When we look at the actual overall economy, well, then we have to pick and choose what we want to see. Because you choose one select group of stats and suddenly it's, not so bad. But we look over there, uh-oh. And this is one of those things, those uh-ohs. Americans owe $1 trillion in credit card debt. This is absurd on many levels. It's connected with this information right here. That deal would end the freeze on student loan payments. SoFi stock jumps. And so we can see what has happened at the time of this recording. The House has passed the deal. It's moving its way through the Senate. I'm sure they're not going to have a problem with that. Why is this the case? Because SoFi Technologies refinances student loans. Student loans are one of the most ridiculous bubbles that I've ever seen, because I think it's at $1.7 trillion or something ridiculous. Those will never be paid back because they have been told over and over again that it's going to be forgiven or partially forgiven and so on. And so this is the case, the curious case of debt. Is it something that we're supposed to pay back, or is somebody else going to take care of it? And that's kind of the world we live in today. $1 trillion in credit card debt, 1.7 in student loans. You are looking at people that are up to their neck, can't breathe, can't do anything because they're so heavily in debt. And then you, the responsible citizen out there, you don't take out any debt. You pay down your debt when you have it. You don't do anything like this, and yet you never see the benefits of the systems and the cycles and the way they turn. When increasing interest rates would crush some people, you might be okay. But at the same time, if it hurts some big businesses, well, then they get bailed out. Well, then they get taken care of. But you were responsible. And it doesn't help you one bit. Do you see where I'm going with this? Well, for a lot of people, they just can't connect the dots. But I want you to understand that debt is infinite in principle. But when it comes to the individual, there is a maximum. Canada's economic crisis. Could high household debt lead to the worst? Those levels are the highest in the G7, and a global economic downturn could have big consequences. This is very true, but you have to understand, where you have a country, or let's just say the two major cities of Vancouver and Toronto, where the prices of homes have gone from absurd to, somewhere off in outer space. It just shows us that they are unwilling to deal with the problem. Already the prices are going higher than they did just before they started increasing interest rates. And just imagine what people are paying every single month, because they're being told inventory is not going to keep up. If you want to get into that school district, if you want to live in that good area, you better do something. That means a little bit of fraudulent paperwork. That means you got to buy homes with, 62 different people living in that house. These are the problems that are being encountered right now, but it's not going to come up on the stats. This is all the way through inflationary. And what does that mean in the long term? How do you fix a problem of inflation if you're a central bank? I've got an idea, and I want you to tell me in the comments below. I had such a good response from the last one where we guessed the $62 trillion China real estate. I want you to think right now, put it in the comments below, and I'll answer that question in a minute. What do you think the solution is for a central bank that has created too much inflation, and a government that might be providing too much stimulus, creating inflation? What will the resulting response be in the next little while? Like, what are they going to do? As part of that, hint, hint, part of the debt deal, what is going to happen here? You tell me. What do you think? Okay, let's answer that question. I'd really like to see where everyone's head's at. Companies push prices higher, protecting profits, but adding to inflation. So you can see what the corporates are doing. Corporations are actively pushing up prices as much as they can. It's important for them because they want to keep their shareholders happy. And that's what we're talking about in this one here. This section is the corporates. They have been doing something that the shareholders love. Goldman Sachs prepares another round of layoffs amid deal drought. Wall Street giant is under pressure due to the fall off of investment banking activity. So they're laying people off. Do you see what they're doing here? They're making the shareholders happy. They're increasing prices. That means inflation on you, the customer, and they are laying people off. That means slower economic activity. If you're laying people off, they can't buy stuff. You know what it means. So this is the result. The result of the activities of the central bank then lead to the corporations, which lead into the consumer. But you can see Zaki, he unveils a scrappier future at Meta after layoffs, saying, hey, we did this because we want to have a scrappier Meta. And essentially just saying that, they got to work harder. That's ultimately what it is. But I thought it was interesting because if you look at a company like this, just maybe not, in the, let's say, the recent days, but the tech industry as a whole, not that long ago, you were seeing all these videos of these people, a day in the life as a Google employee or a Facebook employee and all this stuff. And then they would get in at like 10 a.m. They would go play tennis. They would come back. They'd be at the, getting a massage at work. Then they would be having like, I don't know, the Starbucks or something. And like, there was no work. Work didn't even get done. Then after work, they were going to have drinks with their friends and all this stuff. So that has to end because you can't just do that forever. But now they put AI everywhere in the conference calls, on all of their pages, AI, 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 and now their stocks have climbed quite a bit because that's the new buzzword. But the point is, corporates are doing what they can to appease the shareholders. And this is where we come full circle. Top Fed official sees no compelling reason to wait for a fresh rate rise, essentially just saying that what they're seeing right now is they still have these problems with inflation. They've still got these fundamental issues. They'd rather raise rates again instead of waiting and seeing, because you don't want what happened in the 1970s. And I know some of you were living through that, dealing with that at that time. But not too many are willing to accept this. Oh no, they're smarter today, right? That's what we get. So we have a problem from the central bank level. That makes it to the corporates. That makes it to you, the individual. You've got to be prepared. You've got to know what you are going to do. And I see people doing this. US bank deposits dropped by the most in 39 years to start 2023. Billions and billions pouring out of these companies. This is going to hurt a lot of companies, not just SVB. So you can see the results. This is the result. And then as a result of that, people are pouring more money into the stock market. Do you see this? They're putting money into money market funds as well, but certainly that is the case. And then the government has their own issues too. Look at this. Treasury cash pile hits new low as debt wrangling persists at the time of this recording anyway. So you could see that their own, it's like, think of it like their own bank account going further and further and further. And so you can't operate the government if this thing gets too low. So I'm sure they'll resolve this in the coming days. But the point here is all because of what's happening with the central banks. This is the key. Now, you've got to watch this video. I think it is extremely important to see what you can do as a person, as an individual, because you've got to take care of yourself. You've got to get out of debt. That is essential right now. You've got to get out of debt, because if you're in debt, it's going to only get worse here until interest rates drop right down to the bottom again. So in this video right here, pop it up on the screen. It's going to give you 10 tips on getting out of debt. Click it and I'll see you there.